The purpose of today is just to kind of do some property breakdowns and go through like your property. Choosing one in particular because it's a little bit of a different one. It's a suburban retail in a coastal town. We'll kind of break that down a little bit. You're also an interesting case as well because you're actually a mortgage broker. So do you want to give a little plug about you and what you do and all that type of stuff?
Yep. So basically I work at Investify, basically a mortgage company. And yeah, basically day to day is residential lending and a little bit of commercial.
So on this deal, when you're a broker and you've got your own commercial purchase, do you get someone in the office to do it or do you do it yourself?
Commercial is probably a little bit better because you can actually bend the rules a little bit, I guess, in commercial, whereas residential, you definitely probably don't want to be doing your own stuff, just from a compliance point of view. But with this one, I sort of didn't do it like I did it via like a banker sort of thing. So there's a little bit of degree of separation.
Okay. So did you find any issues with finance or anything more difficult with this certain deal or anything like that? Or what was any bottleneck?
No, I guess in my particular situation, probably pretty straightforward because I went down the lease stock route. So that being, I did a big cash out on my resi portfolio beforehand. So I had already pre-prepared for that. And then I basically, when it came to buying the property, it was just a matter of getting the valuation back, the bank being happy with that valuation. And then
so just for the listeners, Lease Stock is obviously, it's a loan based on the strength of the lease. So part of my job as your buyer's agent is I can't find you a vacant property or something with a really short lease. So part of the criteria is effectively get something with a good long lease. Let's jump straight into it. So let's go into your kind of deal. I'll pull up the screen. Here's your property. So we bought 41 to 43 Parkin Street, Rockingham. That's just a suburb on the south coast of Perth, which we'll pull up some maps and go through it a little bit later. Basically, it's a retail shop in a standard suburban retail strip. The benefits of this one is actually the tenant. So the tenant is the Cheesecake Shop. So that's the big one. Some of the benefits, obviously, a Cheesecake Shop is they are locked to that location. It's not like a hairdresser where they move the chairs and kind of tile the shop up. They've got a cool room and probably about 300, 400 grand fit out. So they're locked in for the success of the business. The other cool thing with this deal is we're actually owning two shops next to each other. So if they ever actually leave the premise, we can fill it with two different tenants and it's got a bit more versatility that way. But in terms of the actual property itself, long-term tenant. The other big thing, and this is what we mentioned with the lease terms for the lease stock loan, is from memory, I think it was 2 5-year leases, wasn't it? It was like a 20 to 2025 and then a 2025 to 2030. And we spoke to the tenant as well, and they are definitely keen to stay on and business is going well. And we can go through a bit of a breakdown of that later. But yeah, general things I like about this property is it's in a little kind of shopping center. There's nothing else around it. There's no major shopping centers. You're on the coast. You've got that kind of scarce factor. And then basically the zoning is residential everywhere else. So you're never going to have any competition tick it over. I won't sugarcoat it. The risks with these little shopping centers is it's not like industrial property where if you lose your tenant, you fill it in a week or two. It most likely, if you lose this tenant in 2030, you may have 6 to 12 months vacancy to kind of fill it. Hopefully not, but just realistically. However, once you get the tenant, they stay there for the length of the business. So average tenure in this complex is kind of 10 to 20 years, which is good. So having 6, 12 months vacancy every 10 years, the numbers still make sense. It's on a cul-de-sac, not cul-de-sac, it's on a roundabout as well, which is good street frontage, but we'll break that down. The yield isn't outrageous, but we're not buying it for an outrageous yield. I think it was at 5.4%. We'll pull up the cash flow spreadsheet a little bit later. The yield is 5.75%, which is strong. We can get high, but this is the stable tenant and the fit out that we're paying for. We'll just show you some pictures here. Yeah, so it's just a little suburban strip on the roundabout, like I said, for good street frontage from the side, and then surrounded by residential. So we'll actually pull up a map. That might be a cool way of doing it. All right, so Rockingham, South Coast, Perth. You can see where it is here. So no land to be released. There's an environmental centre nearby. The rest is completely infilled with residential, which I have a look here. And there's nothing around. I think there's a liquor store around the corner somewhere. Let's wait for that to load. Yeah, there's a liquor store down the road. And then that's basically it. You've got this whole region here of no competition. The next one where commercial is zoned is over here, and there's some kind of like a bigger shopping center, some hotels and stuff like that. So you're encapsulating this whole region just for that. Positives as well is versatility. Obviously, if you lose your tenant, it's going to be anything that the suburban retail strip can have. Actually, the other good point is these also double as offices, because I think there's a conveyancer in the lot as well. So you can have things like law firms, accountants, then the more retail-y type ones, barbershops, hair salons, medical centers, dog groomers, anything like that. So some good positives. And then, like I said, the risk with this is retail. So small suburban retail has a slightly longer vacancy period. What did you like about the property, or what did you not like about the property when we first found it and presented it to you?
Well, I guess the key one is probably the tenant is a bit more prominent. I guess it's not just Joe Blow's cheesecake shop. It's the actual brand, I guess. So there's a little bit of that. I like the location sort of thing. It was near the coast. I like the suburb and that sort of stuff. Probably the drawback probably was that it was retail. I guess I was in my mind gravitated a little bit more towards the safety of warehouse sort of thing. But on the whole, like, it's sort of balanced out that sort of.
I think with your personal portfolio moving forward, we wouldn't keep buying retail. I wouldn't go out and buy you 3 of these in different locations. I'd definitely say, look, let's diversify and get the industrial, and then skew the portfolio to having kind of be probably 2/3 industrial. And then you'll start looking at other ones, like the 4th one might be like a medical or something like that. So just a really good balanced low risk portfolio. But yeah, this one kind of ticks the boxes for me, and that's why we obviously presented it to you and we really like it. And you've had no issues with the tenant or anything like that yet, have you?
No, smooth. Rent comes in on the first of
the month. We'll go to the due diligence report. So on this one, the franchise actually owns the lease as well. So it's not just the franchisee. They sublease off the franchisor. So effectively, you've got the Cheesecake Factory, which have like, I can't remember, it's like 300 plus locations that hold the lease with the security and the guarantee. So up until 2030, you're basically going to be guaranteed rent, which is quite nice. And then after that, obviously, if they move on, that's an issue. But yeah, good tenant, good fit out, decent location, scarce location. So ticks all the usual boxes for us. Let's have a look at the cash flow and the return on investment for this property. Let's have a look at the cash flow on this property, and we'll break it down a little bit. So purchase price, 570 grand. We'll have a 30% deposit. So yours effectively is 100% loan because you pulled the money from equity, but I'll leave it at 30% just because it's a lot of people do have the cash sitting there. And it's also just good for comparisons like for like when you compare with residential. So total cost, you're probably looking around 200K for this property because 171 grand is 30% deposit. Stamp duty's around 20 grand. And then additional purchasing costs like conveyancing, legals, lease review, valuations, things like that. So that's where you round that 200K. Interest rate is 5%. That's in this market, it's a bit higher. So I think you mentioned before, it was about 6.09, I think you said. 6% interest rate. We'll leave it at 5 just because of a nice 30-year average. It's good for like comparison. And then we'll have a look there. Net rent, 32,700, which ends up being a 5.74% net yield. So that's fairly strong yield, like really competitive compared to Sydney, Melbourne. For Perth, probably the market's around that 6%. However, this with the security of the 10-year lease, effectively this is why we like it, and the fit out and who the tenant is. We'd rather the no stress for the next 10 years as opposed to trying to get an extra couple grand a year cash flow. And then looking at, you're also going to get depreciation. So you mentioned on this deal, you get $5,000 per year depreciation, which is quite strong. I thought it'd be a bit less. Yep. That ends up being a cash flow of 17 grand a year. So quite strong when you compare that with residential. You go buy a 570 grand residential property now, you're neutral or negative. Now we're 17, 18 grand a year positive. Where this money comes in, and this is where a lot of investors kind of say, oh, don't buy commercial, I can get better than a 5.74% net return in shares, is the cash on cash. So you've put that 200 grand in, you're actually getting a 9.18% cash flow, cash on cash return, which is quite strong. Where property really outshines shares is with capital growth. So if we get 5% capital growth year on year, which is the 30 average for types of properties like this, you're looking at 24% return. That is far going to outweigh any kind of low risk shares or anything like that. And that's where commercial comes together. You can win on all fronts. If you can get the cash flow and you get the capital growth, you get a really good return there. One of the other things I want to show you is potentially how like a commercial pays itself off. And lease stock loans are a little bit different, like we mentioned before. Lease stock loans are a little bit different to before because typically they're interest only, which I assume was what you've got, Jared, an interest only one. Yeah. What happens is at the end of the 5-year lease, you then get another lease stock loan for 5 years and so on and so forth and go from there. But I just want to show what happens if you actually put the cash flow back into the property as over time. So for this same property, same numbers, we're looking at the 5.74% net yield. Rental increases are quite high at the moment because of inflation, but we can change that to whatever we want. We can say 5% rental increases or 3% or thing. I'll leave rolling rate at 5% just for the like comparisons. And you can just see here, if you put that cash flow, I don't have depreciation in here. That's why the cash flow is a little bit lower than before. If you put that cash flow back into the debt, you can actually see in sub 15 years, we're at like 12 years, the property's paid off and you've got a 50 grand passive income year on year, which is quite strong. Like to do the same thing in residential, it's 30 to 40 years. Commercial, you're doing it in 12 years. This is where it really pays off. If we get more rental increases or we put that depreciation in, for instance, so you said 5 grand depreciation per year, that brings it down to 11 years. If you want to put in, say, 15 grand a year into it, in 10 years time, you're going to have a $50,000 passive income. If we buy 2 of these, instead of buying a house in Sydney's West for 1.2 mil, we bought 2 of these, you can literally retire on 100 grand passive income in 10 years time. This was my light bulb moment for commercial is, okay, there's actually a way out of this rat race. You don't have to think. I don't want to sugarcoat it though. There are risks with commercial. You got bigger deposits. You need to know what you're doing. And we'll go into that in a sec when I show you the due diligence report of how much actual work there is involved. Let's have a look at one more spreadsheet before we get into it. I really like this spreadsheet. So this spreadsheet basically calculates what interest rate you need to see for it to break even. So for this property, basically you need an 8.62% interest rate to hit you before you start paying out of your own pocket. And then that's part of the risk mitigation for commercial property. When people say, oh, residential's lower risk than commercial. One, if a residential's negative, say 10 grand a year, in 5 years time, you're down 50 grand if it hasn't grown at all. So that's a risk as well. Whereas we're going to be up with our cash flow of that 15 grandish, we're going to be up kind of 60, 70 grand in 5 years time. So if the property does go vacant, we can handle the mortgage for a couple of years, but it also kind of mitigates the interest rate rises. So if interest rates go up to 7, 8, 9%, you can stomach that. You can actually weather that storm and keep moving forward. So this is a quite nice calculator. All these calculators I'm showing you, just go on the website and download them. They're free in the resource section, so you can have a play yourself and change the interest rates and loan value and change it to principal and interest and see what happens there as well. So download those. I'm gonna show everyone your due diligence report now as well. I want to reiterate, it's not like residential investing. Like there is a lot of work to do. So I'll show you what the due diligence report looks like. These due diligence reports is what cross-checks everything. We go through lease review, contract review, we interview the tenant, building and pest inspections, we check the business owner's credit history, check their ability, check the competition analysis, things like that as well. Quickly go through this so people get an idea of how involved it is. They're normally about an 80-page report. And we basically we don't sugarcoat anything. We go through it and we say, these are the positives, these are the red flags where we need to look at, and we'll highlight them to you, then let you know, okay, this is what we want to do, or are we going to renegotiate the price, or do we want to crash the deal and things like that. But I'll just quickly scroll through. We look at the location, how far it is to get the CBDs. You can see on the map here, we say it's a 9-minute walk to the beach. It's actually not, that's going to the middle of the beach. It's actually about a 3-minute walk to actually get to sand. And then we go through all that. The zoning, I mentioned before, so you can see here, we're located here. The blue is a commercial zoning. So there's the liquor store that's across the road. Then when I zoomed out previously, that was the shopping center and things. So we've got this whole region where nothing else is zoned commercial. They're not building any more commercial. You can service that housing. Hopefully down the track, they'll actually start building some apartments and get more density there, and that'll actually help with the capital growth. But for now, it just keeps the risk really low. We've obviously checked flood zones, easements, all that type of thing. Did the building and pest report and just found some stuff like the gutters are blocked, carport's a bit rusty, things like that. And we obviously can get money off if we're concerned. Spoke with some engineers. There's actually some solar panels on the roof as well, which is a positive and a negative. I believe from memory it was the owner's expense, which also means that they have to look after it, but they also may get disgruntled or not maintain it to an adequate standard. But part of the lease review is checking who maintains all that type of stuff and who owns it, especially. So any investors watching, go through the lease, especially when you've got cool rooms, and make sure there's like maintenance schedule, who's responsible for it, what the condition needs to be if they leave it or if they're taking it, and things like that. Okay, so this is just what I mentioned before about the types of tenants you can also get. There's accountants and conveyancers. There's a barber shop there as well. We look at other businesses nearby just to get an idea of kind of who the competitors are as well. The big one for me with commercial is talking to the tenant though. So we also do a bit of stalking on social media and find out like, okay, any negative reviews, what they are for. This is a new business owner who bought it, I think about 5 years ago. Oh, there we go, 7 years ago. So we transcribed the interview that we have with the tenant just to see if they're happy, who their competitors are, if they're definitely signing the next lease and things like that, how business is doing, all that type of stuff. Everything came back squeaky clean on this one. This would have been a deal we would have crashed if they said they were leaving. I don't think we probably would have bought it. You probably agree that if they said they're going to leave in 3-4 years time, probably would have talked you out of it. But everything came back with DD quite strong, which is good. And then the last thing we'll probably have a talk about is obviously part of the due diligence is looking for what's for sale at the moment, what has sold in the region previously and how much for per square meter rates. This, because there's not many comparables, is actually a positive and a negative. We don't have many comparables, but that's also mean it's a tightly held area. So that's there. We do have valuations as well. We've got an in-house valuer. And then we look at comparable rentals as well, just to make sure they're paying fair market rent, not overs, not unders, things like that, and get that secured there. Have a look at the vacancy periods and try to find some similar suburbs around Perth, a similar property if it went vacant, how long it was vacant for, and give you a bit of an idea of, okay, this is how long the property's going to be vacant if we lose it. But yeah, we don't try to sugarcoat. We literally send you everything that we've found, so that way you're at least making an informed decision. You can see here, like, we've got about 20 comparable properties of what they are, how long they've been there for, square meter rates. And then yeah, this, from what we found, was 1 to 5 months. As I said at the start of this kind of podcast episode, I'll say that again. As I said at the start of this kind of interview, it was probably 6 to 12 months, but this one's actually 1 to 5. But I always be conservative. I don't want to kind of tell a client it's going to be filled in 2 months and then it takes 12 months. So, but yeah, on the whole, property stacked up really nice. Good long-term tenant, franchisee. All right, so Jared, are you comfortable talking about a little bit about your portfolio and what drew you to commercial over just sticking with residential?
Yep, 100%. Yep. So I guess I was sort of at a bit of a crossroad from with my portfolio. So I had a lot of equity in the portfolio, and the decision was, do I keep going down the residential pathway or do I go commercial? Going down the residential pathway, I've already had a decent sized portfolio. So the interest expense and the net yields on a resident portfolio, it was going to be heavily negative. So it was like, if I was going down that road, I was almost of the opinion, I just don't want to keep investing. However, if it was cash flow and, it was taking care of itself, because I'd be lending 100% on the property purchase, and the rates were actually cheaper if I went commercial than if I went residential, just because I would have had to start looking at, second tier lenders or third tier lenders in the resi space. Whereas going down the commercial space, I was able to get actually a lease stock loan, at rates that any other person would get on a full doc rate. It's slightly too neutral, and with growth in the rental and all that, it would actually make it positive and put money back into my pocket. Whereas residential,
yeah, I'm actually finding that most resi investors, even if they've got a little bit of capacity, they're not willing to stomach the negative gearing, because it is like, if interest rates keep going up, especially if they don't enjoy their job or something, they're stuffed because they know they're locking themselves in. Whereas commercial gives you a little bit of freedom, because it's like your one, even with the equity pullout, we're pretty much neutral, which is good. So you can keep kind of progressing the portfolio. What we'll hopefully find in the conversation when we do a follow-up, hopefully in 2 years' time, is we'll do it and you'll be saying, the rents have gone up 30-40% because of the inflation. Then all of a sudden that's very positive. Hopefully interest rates come down. We see rents go up, interest rates come down. And then we showed you, even in, 10 years time-ish, it's a 50 grand passive income. Hopefully that's an 80 grand passive income, and we can step away from there. But that'll chop and change over time, and then hopefully we'll accumulate 1 or 2 commercial, and then your portfolio is very strong. Good base of resi, good base of commercial, and then it's up to you whether you want to keep pushing the envelope or step away from work or do work part-time and do all that type of thing. Is there a reason why you didn't do it alone, Jared? Like you went and like you're an astute, like an investor that understands what he's doing. Why did you use a buyer's agent? Why did you trust some bearded guy?
I guess by the whole definition, like why not go get your own loan? Because as a mortgage broker, I've got access to 20, 30, 40 lenders, whatever. So and I'm seeing it day to day. I know. So same as a buyer's agent, like you guys are going to have the connections. You're going to know what areas are working and not. And I just don't have the bandwidth to, and I probably know that I can't get my head into across everything that could possibly happen. Like you guys probably learned from the problems that you didn't even know existed, and then I get the benefit of coming in after the fact.
It is funny when I tell people, I'm like, I still learn stuff every day, and I've done 1,500 deals, so I can only imagine how much you think you know if you've only done 1 or 2. You're a little bit luckier because you're a mortgage broker, and I've actually worked with your office quite a few times, probably 10 plus times now. You've kind of seen the deals come across anyway, and you've seen how we work and the client feedback. So it wasn't a total leap of faith. I've actually worked with quite a few in the office, as you know, as well, even the brokers and the clients. So I think it was a bit more of an easier choice for you. But yeah, commercial, if you keep the risk low, for me, it's just a game changer, which is nice.